Welcome to The Explainer. Today, we're digging into a huge shift happening in the world of financial technology. We're moving away from all those loud, disruptive promises and towards something a lot quieter and a lot more foundational. For the last decade or so, fintech really only had one personality. It was aggressive, and this right here, this was its mantra. It was all about pure disruption, moving fast, and breaking things. So, what happens when all those growth hacks just stop working? That's the billion-dollar question, right? Because that whole era of just wild, unchecked growth, it's pretty much hit a wall. And now the entire industry is changing. A new, much quieter phase is kicking in as everyone, and I mean everyone, from tiny startups to the big giants, starts to, clean up their room. So what we're really seeing here is a fundamental vibe shift. The whole attitude is changing. We're moving away from that loud, fast, cool promise of the disruption era, and we're heading towards something quieter, sturdier, and way more focused on the boring but crucial stuff, the infrastructure. And this is the big idea we're going to unpack today. We're calling it the recomposition era. So what does that mean? It means it's not about tearing down the old system anymore. Nope. It's about rebuilding, it's about maturing, and it's about making the entire financial system stronger, but from the inside out. Okay, so how do we know this isn't just a theory? How do we know it's really happening? Well, we've got three perfect examples, three recent signals that show us this trend in action. All right, let's jump into our first case. This one is all about how new, exciting tech, think crypto, isn't actually replacing the old guard. Instead, it's getting absorbed and kind of tamed by it. And this story involves a company you've almost certainly never heard of, DXC Technology. Look, they don't make the shiny, cool apps you have on your phone. They're the massive, almost invisible IT provider that runs the core systems for the biggest banks in the world. If the app is the shiny paint job, DXC is the concrete foundation underneath. So, check this out. DXC just partnered up with Ripple. But, and this is the key part, they aren't out there slinging crypto tokens. No, they're selling blockchain rails. Think of it like the trusted, super secure plumbing that banks absolutely need if they're going to handle digital assets safely and legally. And this is just a perfect example of what we're talking about. DXC is basically providing this institutional layer of trust that takes a volatile, kind of wild technology like blockchain and makes it usable for the super regulated world of finance. This is how crypto stops being just a risky asset and starts becoming actual infrastructure. Quietly, boringly, and permanently. So what's the big takeaway from this one? It's simple. The next wave of fintech isn't about startups replacing the legacy players. It's about those legacy players absorbing the new tech and making it part of their own stack. Okay, that was case number one. For our second signal, let's shift gears. We're going to move away from the big legacy guys and look at the startups themselves, because their whole mindset is changing from just growth to long-term survival. So let's talk about the consumer fintech company Dave. You're not seeing flashy headlines about a new feature from them. Instead, they're doing something that's way less sexy, but honestly, way more important for their future. They're rebuilding their board of directors with seasoned, experienced operators. They're bringing in the adults. And this shows a really critical evolution that a lot of fintechs are going through right now. See, when you're an early-stage startup, everything is optimized for speed. Just go, go, go. But after the really hard lessons from the market correction a couple years ago, public companies have learned they need to optimize for something else entirely: survival. And why the big change? Well, because every company that survived the big downturn of 2021 and 2022 learned the exact same lesson. And this quote just nails it. Regulators don't care about vibes, and capital markets don't reward chaos. At the end of the day, stability and solid governance are what really matter. So the big point here is that the very definition of success is changing. It's not about how fast you can grow anymore. It's about building a company that can actually last. This is what fintech maturity looks like when the growth hacks stop working. All right, this brings us to our third and final signal. And this one shows how the real innovation has moved from the flashy stuff you see on your screen all the way down to the foundational plumbing. Okay, so for this one, we're looking at Regions Bank and a company called Global Payments. Now, Regions Bank isn't trying to build the next Stripe themselves. No way. They're doing something much, much smarter. They're outsourcing their complicated payments tech to an expert in the field, WorldPay. And what this shows us is a whole new model. On one side, you have the banks finally admitting, hey, we can't build everything ourselves, so they become the distribution layer. On the other side, you have the fintechs admitting, you know what, we need the bank's millions of customers. And the result? It's a much more modular, kind of plug-and-play system where everybody just focuses on what they do best.
So think about what this means. The most exciting innovation in payments today isn't some brand new app. It's happening through this process of replatforming. It's about building these incredibly powerful, safe, and stable operating systems that banks can just plug right into.
And that brings us to a really powerful takeaway for this point. The game has totally changed. The focus has shifted decisively from slick user interfaces to robust, reliable infrastructure. Okay, so let's tie this all together. We've looked at three really different signals, right? Legacy IT absorbing new tech, startups prioritizing survival, and banks rebuilding their core stock. So what's the common thread here? Well, when you lay it all out like this, you see a really clear pattern emerge. You've got a legacy IT company absorbing new crypto tech, you've got a consumer fintech hardening its internal foundations for the long haul, and you've got a payments giant becoming the essential middleware that powers a modern bank. It's all the same trend. So the big overarching takeaway here is pretty clear. That chaotic, grow at all costs age of disruption, it's over. And a new era, a quieter, more mature, and ultimately a more durable era of recomposition has officially begun. And look, this shift is absolutely monumental. Fintech is trading disruption for durability. It's setting the stage for a future that's way more permanent and integrated. And that leaves us with one really exciting question to think about. Now that this new, sturdier foundation is being laid, what are they going to build on top of it?